Hello everyone, and welcome to today's Projects at Work webinar in coordination with UMT360, Learn Why Strategic PMOs are Moving Beyond Annual Planning. My name is Andy Jordan, President of Refenzian Consulting, and I'll be the moderator for today's session. Before I introduce our speaker, just a couple of admin things for everybody. First off, this session is being recorded, so if you want to share it with your colleagues afterwards, you will be sent a link about 24 hours after the presentation, and that'll contain details of how to access the recording so that you can listen to it again or share it with other people at work. In addition, we will also be sending out a copy of the slides at that point, so you'll have information as to how to get details of those. This webinar is eligible for a PDU, and we'll give you all the information you need to claim that at the end of the presentation. And also, once our speaker has finished presenting, there will be some time for questions and answers. So if you see the question panel, the chat panel in your GoToWebinar session, please feel free to use that, type in any questions that you have, and we will get to as many as we can at the end of the presentation. During the presentation itself, we also have a couple of polling questions, so look out for those, and I'll give you full details as to how to take advantage of that when we get to that point in the presentation. So without any further ado, let me introduce today's speaker, Frank Larocca. Frank is the Director of Business Improvement Services within the finance organization at Consolidated Edison. He's responsible for investment optimization, both capital and O&M, the Enterprise Project Management Office, and business process improvement. Prior to Con Edison, Frank spent 20 years in Keyspan Energy in the information technology area. In 2002, he assumed the role of VP Information Technology and CIO. By creating several new IT governance committees, reorganizing, and by implementing several best practice new processes, he was responsible for transforming the IT organization and building a comprehensive 5-year IT strategy and vision. Frank brings a strong and diverse background, including all aspects of information technology and financial governance. Accomplishments include startups and merger integrations, business transformation, and cultural transformation. Frank lives in downtown Manhattan. He enjoys photography, fitness training, including teaching cycling classes, and he's currently studying the Italian language. Frank has a Bachelor of Science degree in Computer Science with a Business Administration minor. He is also an exceptional speaker, and this is going to be a lot of fun and entertaining and valuable for everybody. So, Frank, over to you.
Okay, no pressure. Thank you. Thank you for the introduction, and I'm happy to be here today sharing my journey creating a PMO, specifically for Con Edison. So for today, our agenda is really adopting a strategic mindset for the PMO. I think traditionally PMOs have been thought of as project-centric, and our goal is to turn that into more of a CFO mindset, as if all of our projects are portfolios and we're governing the value of the portfolio. So I hope to share with you some of the lessons I've learned, give you an overview of what I'm calling dynamic reallocation. We also call it sweeping, and I'll share some of the tools and techniques I've used to create governance and build metrics and share analytics. And then hopefully, as you said earlier, we'll take some questions. So I'm not going to spend a lot of time on the Con Edison slide. We are one of the largest utilities, and I'm happy to say that I live in Manhattan, so it's an awesome accountability to power an amazing city, and we all take it very, very seriously. And so you can read the stats here. We serve many, many customers, and we provide electric, gas, and steam. So where does it all begin? Both at Keyspan Energy and at Con Edison, you know, it's fairly obvious to say that everybody is doing more with less. It seems like the budgets seem to be getting cut and cut and cut, and so I think we're all being forced to be more strategic and judicial in how we're spending our money. So big questions I've been asking a lot is, how much are we spending in total on projects and programs? Are we utilizing our discretionary budget in the best way possible? Are our investments in line with the corporate strategy? Do we have the right metrics in place to gauge our performance? what is the strategic value of the portfolio that we're supposed to be delivering, and are we getting the right return on investment? So these questions might seem obvious, but I found in both instances at Keyspan Energy and Con Edison that sometimes this data is not readily available, and it really takes some time probing and getting at these answers and building the answers to these questions. So my ePMO is broken into two major categories. On the left we have optimization, and on the right we have management. So on the optimization side, we're all about, are we selecting the right projects? Are we doing the right projects? And on the right side, once we think we have selected the right projects, are we doing projects right? So are we executing effectively? And I would make the argument that if you're really good at selecting projects and you get the best projects lined up, but then you're poor at execution, you're not going to deliver the total company value that you could. Or conversely, if you're really poor at selecting projects and you're really good at delivery, you're also not going to get as much value as the portfolio as you can. So my goal in this ePMO is to look at both aspects and make sure that we are effectively selecting the right projects, because there's always going to be more demand than we can actually execute. So my goal is to make sure that we are selecting the right projects and then executing them effectively. Which leads us to our first poll question of the day. I'd like to know, what is your bigger concern for your organization? Is it on the project selection side? Is it on the management side, or do you worry about both?
All right, so I'm just going to promote the survey now for everyone to see, so it should be appearing on your screens in just a couple of seconds. And as you can see, that there is an opportunity for you to select the selection, the management, or both, and we'll give you just a few seconds to do that. Now, I can cheat a little bit here, Frank, because I can actually see the results as they're coming in, but what do you think we're going to see here?
I think it's going to be a little bit of both.
That's always the nice, safe response. And
exactly.
I think you may have done this once or twice before, because I don't think you're going to be hugely surprised by what we see. So I'll just give everybody a little bit more time to vote. Looks like we've got most of the votes in already, so just a little bit longer, and then I'll close it down and share the results with everybody. All right, so let me just close that, and I will share the results with everyone, and you can see 53% said both worry them, 29% said project selection was the biggest concern, and just 18% project management, which is a fairly positive sign, I guess.
Yeah, I think that's, well, it's not out of line with what I was expecting. I think that over time we have become, in general, businesses have become much better at project management, and it doesn't surprise me that people are now turning to, are we selecting the right projects, and, you know, considering both of them as equally important.
Yeah, I think that's fair. All right, let me close that, and we'll go back to the slides. There we go. So back to you.
So the slide that I showed earlier was a simplified version. I'm sure everybody is aware. But when I think about capital project management, or even O&M project management or governance, you really have to think about the whole life cycle. And there are 5 chevrons here. And so my group is concerned with how are we creating proposals to spend money, so that's your business cases, your cost-benefit analysis, your contingency estimating. How do you select? How do you get the algorithm to select the right projects for all the projects that have come onto the table for selection? Then once you think you have them selected, how do you plan? From planning goes into management, making sure that they're executing appropriately. And after it's all said and done and all the projects are completed, you want to take a look back and evaluate how did you do. So there's a lot of processes under each one of these. This isn't meant to be a complete slide, but certainly there are a lot of processes below. So each one of these checkboxes are things that my group is trying to focus on and trying to build enterprise-wide processes for all of this. So on the bottom you'll see that we're using UMT360 to do a lot of this work. On the left side, on the optimization side, all $2 billion of Con Edison's capital spend goes through this optimization process. So everybody submits the same way, everybody does their proposals, the white paper collection the same way, and we optimize the portfolio. On the management side, which is really the focus of today's presentation, we're using UMT to help us automate this work, and I'll be sharing a lot of what I'm talking about in the subsequent slides. So far, we have about 200 of that $2 billion fully automated using UMT360. 700 million is in progress to be implemented shortly, I would say between the next 6 to 8 months, and the rest we are planning to do in the subsequent years. We were all manual for a period of time, but it's impossible to manage the breadth and the scope of these portfolios. When we were just managing $200 million, we could do it through spreadsheets. But now that we're in the $2 billion range, we absolutely needed a tool. So let me take a few moments to share with you what are we doing on the managed side that I think is perhaps a little different and maybe on the cutting edge, and I hope to add value to all of you who are listening. So the goal of the governance is really, my group, I always say, we're here to facilitate, we're here to make sure standards are adhered to. We provide non-biased, proactive portfolio as opposed to project management. We're here to help influence improved project and program management. We monitor the health of our projects as well as the portfolios. We try to increase strategic budget utilization. I'm sure all of us are very good at spending money. That's not our goal here. Our goal is to spend money efficiently and effectively, and if we can do it better, cheaper, faster, then we're going to look for that route. I also want to manage churn by making sure that we're formalizing investment reallocation decisions. I'll get into churn a little bit more later, but are we executing the portfolio that we select at the end of the year? How much churn, how much changed? And we're also looking to foster holistic versus siloed decision making. So one of the first things we did was after we assessed the lay of the land of what's going on in terms of project management is we interviewed a lot of project managers, and what we found is culturally it is better to dramatically underrun a project than even slightly overrun. So, you know, there was a fear if you go over, then you're gonna stand out, your project is gonna be red and it's gonna be bad. So that has led to some sense of reward if you're significantly under budget. But we all know that if you are significantly under budget, that means that there were monies that went underutilized throughout the year. So we asked them, why do we think that we are you know, holding on to this money, and what can we do about it? So we found out a couple of things. Number one, the project budgets are set once a year. So in the past, project managers would say, okay, this is my estimate. It would go into our official budgeting system, and it would be locked for the year. And then, of course, reality happens, and the original budget, the original cash flow is nothing like what the project manager had anticipated. So they felt that they were trapped, that they were being held accountable for that original budget when at that time they didn't have enough scope clarity, they didn't know enough about the project, they didn't know a lot of the details, so it was really order of magnitude estimate. So as you can see here on the rest of the slide, the original cash flow does not reflect recent information. We really didn't provide a lot of formal project management or estimating training, so we're offering more of that. Oftentimes, project managers who are being held accountable for these estimates weren't the ones who originated the estimates. And we also didn't have a standard methodology of calculating project contingency. We found in our analysis that some projects, some groups were adding 0% contingency, and some groups were adding 40% contingency without really a lot of rigor around that. So we listened to our project managers, and we've made changes to our processes based upon this feedback. So we developed what I call a sweep. And essentially what that is we're not sticking to the original estimates that become stale. We are holding our project managers accountable for reforecasting and recash flowing. We are challenging underruns as much as we do the overruns. We are pooling underruns into what I call a surplus fund. And we allow people to request additional funds from the surplus fund as the year goes on. We have a sanction process, which is a formal approval process to approve releases, projects letting go of money, and projects requesting money or new projects. And then we compare the month actuals to both the original forecast as well as the revised sanction forecast. And then we document all of the sweeps, all of the pluses, the minuses, the releases, and the requests. Then we do this monthly. And we found this has had dramatic impact and value to the portfolios that we manage. So how does the governance process work? Again, this is all relatively new for Con Edison. We have at the bottom of the slide what we call the governance committee meeting. We have one of these meetings for each one of our major commodities. So we do one for gas, we do one for electric, and we do one for steam. And we have a couple of other portfolios. But prior to that meeting, a lot of work happens. So we have what we call, it's probably not the best name, but we have a meeting literally called the pre-meeting. And here we do a detailed review, project by project, of various portfolios. And nothing surprising here. We do the status reporting, risk and issue discussion, variance discussion, reforecasting, and so forth and so on. And there's a lot of people at this meeting. We have the project manager. We have a group of our finance people there who are in the cost management department. And my group is there. And we're all there not to play Big Brother, not to judge, not to be an auditor, but to help project managers. And out of this meeting, my group summarizes a lot of the trends, a lot of the data, and we present it up at the governance committee meeting. It sounds fairly basic, and I would say it is. It's just about building the mechanics to do this, scheduling the meetings, getting the right people in the meetings, understanding the meeting cadence, having the right information available, rolling it all up so that when you get to the governance committee meetings, you can have a very effective discussion of what is going on in that portfolio and looking at the requests and the releases that come in. So for an example, at a governance committee meeting, we always start with the current budget. Project managers will release money. So these releases come in many forms. Sometimes the project manager will volunteer the release. And this is also cultural, so you have to encourage them that releases are not a bad thing. So they release money. My group will challenge and ask project managers to release. If we're looking at trends and analytics and we see, hey, you're not spending the way you're supposed to be spending, we think we can sweep money away from you, we're strongly suggesting a release. So I would say releases are voluntary, releases are probed, and sometimes they're a little bit forced if project managers are reluctant. But then we look at requests. So requests come in. These can be in the form of an existing project that needs more money or a brand new project that has just emerged and is a great idea. So the committee will look at the releases and the requests, and we call this the sanction process. Literally at these governance committee meetings, the senior officer is there evaluating these pluses and minuses and making decisions and sanctioning them as we go. And the result of this will be our new sanctioned forecasts. So essentially what we're allowing is dynamic reallocation of funding utilizing a pool. As projects release money, they go into a pool, new projects request. It's often not a one-for-one. Sometimes you have a surplus, sometimes you have a deficit, but it's been a really effective process. And one of the things that it really brings about is transparency, because I would say a lot of these decisions were being made in the past, but they weren't as formal. The process wasn't as formal. So we didn't have as much transparency, visibility, or auditability in these pluses and minuses. And oftentimes in the past it was hard to determine where did the churn, where did the moves go. Now we have a fully automated system that tracks the releases and the requests, and at the end of the year we can literally summarize where were the biggest releases from, where are the biggest requests, and how much churn actually occurred in the portfolio. So I'd like to walk you through an example of 1 year, one portfolio, and how the results of the sweep process worked. So as you can see on the top left, quarter 2, we had a budget of about $188 million in this particular portfolio. Through the sweep process in the first quarter, we experienced and approved $17.8 million worth of releases. $8.2 million of projects came to the table requesting funding and were sanctioned, and $7.8 million of existing projects requested more money. So the net result of that, after that quarter review, we had a surplus in our surplus fund of $1.6 million, meaning we had budget to spend if there was a good project that came to the table, or if an existing project needs more money, we had the ability to fund it. Again, this is not a spend it or lose it attitude. This is really the committee, the governance committee is very judicious in what it approves and what it sanctions. So I'm not going to drain you through each one of these quarters, but as you can see at the end of the year in total, we had $35 million released. We approved $17.5 million worth of new projects, and we redirected $15 million worth of money. So I would argue that had we not had this process, at a minimal, this $17.5 million would have not been funded. These new projects would have had no ability to get funding, because if our past process was kept alive, it would be likely that none of the releases would have occurred, or if they did occur, they would occur towards the end of the year, October, November, December, when you don't have enough time to react and to fund something new. So this process immediately added value the year that we implemented it, in the tune of $17.5 million worth of new projects funded. So I could see here as an immediate example of the EPMO adding value. I want to share another example with you, and I think it's important to again think about your projects in terms of portfolios and not just status code your individual projects red, amber, green, but take a look at the health of your entire portfolio and make some assessments here. So this was live data at one point, so let's pretend right now that it is September and our actuals are the purple line in this graphic, and the gray line is a blended average of the spend in this particular portfolio for 2 years. So you can see for 2011 and 2012, that was our average spend. Well, the first thing you might notice about this is that the purple line and the gray line are almost identical. What you might also notice is that the projections start. So the projections are the blue line, and you can see that the projections start separating and get higher and higher from our 2-year trend average. So in our quarter 2 revision, you can see that we forecasted to be at 66 million, and that's where we ended up. Our projection in June for July was 80 million, and we ended up spending 74. Not too bad, $6 million below. Our projection in June for August was 98 million, and we only spent 85. So the gap is getting bigger as we get further and further away from the last cash flow, the last forecast. So what I did was I took this information in this very graphical form, and I asked the committee, I got the committee together, and I said, okay, you guys have just given me your third quarter reforecast. That's the blue line. See where it is. Look at our actual line to date. Look at our history. Is anything coming up in the next 4 months that would be dramatically different from the last 2 years? And in general, all the people on the committee looked around the room and said, no, not really. There's nothing significant. So I said, does anybody else have trouble believing in these forecasts? And pretty much everybody did. So the difficulty is that this is not a single project. This is a portfolio of projects. So it was very difficult to have the committee, oh, well, you know, I'll volunteer to give this money back. I'll volunteer to give that money back. So what we did was we said, okay, everybody go back to your respective corners of the world and reevaluate your forecast. Do a much deeper dive and look at it in terms of your ability to spend. Look at how much you spent last year at the same time, and we got some good or better reforecasts. So where did we end up the year? If you look here at this slide, you can see that the purple line is almost identical to the prior year line. Because we were able to predict that we were going to underrun, we looked great because we were able to give back $33 million from this portfolio into another portfolio. So let me just restate that again. We did it back in September. We were able to look at, based upon trend analytics and portfolio view, we were able to look at our forecast and determine that they really weren't realistic. Culturally, I wasn't pointing at any individual. I wasn't pointing at any specific project. We were looking at it holistically. Everybody agreed. Everybody went back, sharpened their pencils, and therefore we were able to give back $33 million to the corporation. Again, I think this is a live example of adding value pretty quickly. And I'm hoping that a lot of you have this information. How much are you spending in your portfolios? What are your trends for the year? How does it play out? I don't think this is difficult information to get. I think it's oftentimes culling the information and turning it into usable information and sharing it with the right people and then making decisions upon it. I want to share this other example. Again, this is data that I feel is the obligation of a PMO to capture and share. This is for another portfolio in my organization. I will be the first to admit that I'm not an expert at the projects that go on in this particular portfolio, nor do I aspire to be. But my role, the EPML role, is to look at this holistically and sort of as a non-biased party with separate, fresh eyes. So let me walk you through the slide. First, the blue bars are our actual spend. The gray bars are the spend that we originally cash flowed. So when we budgeted, that's the gray bar. So the first thing you might notice is that we're pretty much underrunning our actuals to the original cash flow. Then we have a whole series of, a whole rainbow of forecast slides. So we have a forecast on 2+10. What that means, we have 2 months of actuals, 10 months of forecast. That's the purple line. So at the end of February, we forecasted out for the rest of the year. We do it again at 4+8, meaning at the end of April, we have 4 months of actuals, 8 months of forecast, and so on and so forth. So each color, each line represents an updated forecast. The first thing you might observe here is that, as I said earlier, we're underrunning our original budget, And it looks like every time we give the portfolio project managers the opportunity to reforecast, they're pushing their budget up and out to the right. So the arcs can tend to get larger and over to the right, meaning we haven't spent it yet, but it's really going to happen. And you can see here at the 7+5 forecast, there is a dramatic spike in August. That's the orange line. And it looks like we're going to spend around $85 million in the month of August for this particular portfolio. And that's almost doubling the run rate in this portfolio. Another couple of stats that we provide are on the top left. So to date, from January to August, we've spent $326 in this portfolio. Last year at the same time, we were only spending $261, and you can see what happened in 2013. So this is data that we're providing to them. What does that say to them? For the first several months, the spending is higher than the prior years. Now let's look at the remaining spend. We have $310 million to spend in the rest of the year, whereas last year we only spent $247 and $223 respectively. So we also provide run rates. So if you look at the bottom right, we're showing that their run rate for the year so far has been $47 million. Their projected run rate is to go up to $62 million. And we're saying that your peak monthly spend is $90 million in August, when their past peak has been in October of 55 and 51. So again, I am not expert at this particular portfolio. I don't know a lot of the details about the projects that go underneath this portfolio, but I do know, analysis, and I was able to effectively meet with the committee and share with them and the senior leaders of this committee, of this portfolio, and say, this is the analysis, and I'm looking at August, and it doesn't seem realistic that you're going to be able to achieve this amount of spend without some dramatic changing going on or dramatic movement going on. And so this type of information, again, I don't think it's difficult to get at. I hope many of you listening have access to this data, but I think it's about being creative in how you're displaying it, how you're managing it, and how you're talking about it to get some action. And so as a result of meetings like this and trend analytics like this, we have a lot of people going back and really doing a much, much deeper dive and a much more effective look at our resources and our planning and scheduling to see, hey, do our projections make sense? So, done a lot of talking so far. I'd like to hear from you guys. How many of you are sweeping? And I don't mean at home. So how many of you are planning on sweeping?
So I just promoted that that question out to everybody, and we'll give everyone a little bit of chance to respond. I'm going to guess that your expectation here is that there's a lot of people who are not yet sweeping, Frank. But any thoughts on what else we might see?
I would say they're not yet sweeping or looking to start sweeping, but it's probably manual.
All right, so I'll give everybody a little bit more time to vote before we demonstrate that Frank really does know what he's speaking about by showing you the results. Just give everyone a little bit more time. Looks like most people have voted already, but still a few outstanding, so we'll give them a little bit more time. And I see already that we are getting quite a few questions coming in, so that's good. So you're not going to be able to finish early, Frank. You were going to have to stay for the full hour. All right. So let me just close down the poll, and then I'll share the results with everybody. Here we go. All right. So 64% saying not currently sweeping, which I guess isn't too much of a surprise. 22% are sweeping, but it's a manual process. 12% planning to establish a sweep process, and 2% who I guess work for Con Edison, and they already sweep with an automated process.
Again, not surprising. I hope that this conversation is encouraging many people to think of sweeping. I know cultures are different and dynamics are different at every company, but I think that the process is fairly universal and can really benefit dramatically. I know that the benefits have really been dramatic at Con Edison.
Excellent. All right, let me hide those results and we'll go back to your PowerPoints. There you go, it's all yours.
So I wanted to just turn to a little bit of the metrics and the reporting and a little bit of the conversation around the tool. As I was saying earlier, a lot of this is not, I don't feel like it's too difficult to get at this information, but managing it large scale, doing it for $2 billion, we were able to automate it using Excel. We were able to do it manually through Excel when we were at the $200 million mark. But now that I've been asked to extend this process to all 2 billion, there's simply no way I could do this through Excel spreadsheets and the error-prone nature of that. So we're automating all of this through UMT360, and there's a myriad of reports and graphics that help us through this. Here's an example of something similar that I just described. You can see at the top there's many ways to filter your data. You can look at different portfolios. I have a common governance committee, an electric governance committee, a gas governance committee. So my group, once all of this is automated and in one tool, I'll be able to look at all portfolios. I can drill down into a single portfolio. I can drill down into a single project and do very high-level analytics real-time using the software. So how is all of this working? I mentioned to you before that we had a culture of a fear of overrunning and more of a propensity to underrun. So in 2009, for one particular portfolio, we had a budget of 244 million, and we only used 200 million, meaning we only utilized 82% of our budget. Over the years, we've been implementing the sweep process, allowing more effective views of this, and you can see that our utilization has jumped from the 80s to the 90s. So I'm very proud of that fact. In 2012, we had Hurricane Sandy, which had a dramatic impact on our portfolio, so the fact that it dipped to 90 doesn't concern me too much in that year. So I'm pretty proud of these results and metrics. Another metric that I think is important to share, and I would say as an ePMO, you have to put this out there. You have to maybe create a little competition, maybe a little peer pressure amongst the various stakeholders in your organizations. As you can see here, we have a list of projects on the bottom. The blue dot is where the budget, where the actuals came in. So the variation from budget is a big thing. If you look at the distance between the dot and 100%, that's what we measure. So I share this scorecard, if you will, with the vice president. So this is an illustration of what I would give to a vice president and say, on average, you deviated 28% from budget for all your projects. So I publish a report that looks like this for every one of the portfolios, for each one of the VPs, and it incites a little bit of competition, healthy competition amongst one another to try to better improve their deviations and forecasts. Here's another slide that shows our trending. So we put all the sweeping in, we put the reforecasting in, and so in aggregate we went from 38% off of our original off of budget to 18%. So we're slowly but surely improving our forecastability by driving these sweeps and by allowing the reforecasting. As I mentioned earlier, you know, we spend a lot of time, I'm sure every company on this phone spends a lot of time in selecting the right projects. That's on the left. So you do some sort of strategic value, cost benefit, cost avoidance analysis. Then in the middle of the chart you have, you know, the year happens. And things change during the year. Your strategy can change, something can change in scope, finance situation can change, resources can change, and so forth and so on. And so at the end of the year, you want to take a look back and see, well, what percentage of your portfolio that you selected was actually executed. And so by having the sweep process, dynamic reallocation process, we're able to see where are the releases going, where are the redirects going, and we're trying to capture root cause of these releases and redirects so that when we look back we can say, why did we have so much churn, or why didn't we have so much churn, depending upon the situation. So my final slide for the day is, I think a lot of progress was made. When we began, it was almost difficult to find a roster of all the in-flight projects, hard to track down who was the accountable project manager. We had no formal tracking of start and end dates, no formal benefit tracking, no reallocation process. We didn't have a project management society. We had very little metrics. I'm not saying that we did poor. I mean, we ran projects and we did them well, but we weren't looking at this in a holistic portfolio level. And I think by showing some of the examples that I showed you earlier, we're able to more effectively utilize the discretionary budget that we've been given and do more with less. And I think it's hard to measure the value. I mean, we have some stats that I've already showed you, but I also think that it's like a drop in a stream, that the ripple just continues on and on and on. So with that, I will stop blabbing and hopefully take some questions on the process.
Frank, not much chance of you blabbing there. You know, awesome presentation, and judging by the number of questions that have already come in, you've really resonated with our audience. So let me start by asking you a nice, quick, easy question while I go and look through all the questions that are coming in now. So Suzanne was asking about reforecasting. I'm wondering about the frequency of that. Is it something that you're doing on a quarterly basis? Is it more often than that? Does it depend on the portfolio? You know, what happens about that frequency of forecasts?
Great question. So I think it was interesting when we began the process several years ago. We thought we would do it on a quarterly basis because we were afraid to overwhelm project managers. I mean, you know, culture plays a big part of this. And in the beginning, the project managers were not reforecasting. So now it could be perceived that we were asking them to do more work. Additionally, there was some thought that they didn't own the reforecast, and really the budget people own the forecast. So we had to slowly transition accountability to the project managers for owning the forecast. And then we were saying, we want you to do it quarterly. So we were afraid to do it more frequently than quarterly. But I have to say, once it caught on, most of them want to do it on a monthly basis now. So we didn't automate, we didn't hamper any ability to make it, you know, de facto quarterly. We are doing it in some cases monthly and some cases quarterly, depending upon the portfolio and the group.
Perfect, thank you. One question here that came in, and there's a few people asking sort of similar themes, and I think it sort of really goes to the crux of the challenge for a lot of our audiences. How did you go about, what were the techniques you used to get buy-in from the organization when you first came up with this idea? And some of our audience were concerned that there would be a perception that it was a lot more oversight, a lot more scrutiny, and people might be a bit wary of that. How did you sort of drive that cultural change?
Well, I think that's absolutely correct. There is a shyness associated with additional oversight. I could tell you culturally, the word governance was not often used several years ago. It was sort of looked on as a negative thing, but I think we've changed that. Now people know governance is a huge part of our process, and they've accepted it. The techniques I've used were really around, honestly, letting the data speak for itself. I don't think that this was again, I don't think it's challenging to create. It's challenging way to share the information. So when I showed that graphic of the projections versus the actuals and the trends, it's really something hard to argue with. So I think people just jumped on board because it's almost like something you cannot deny will add value. So I think that's a part of it, and I also think it's, honestly, it's a bit of my personality. I just wouldn't accept not doing this as an answer. I think it's crucial to have somebody in your organization spearhead true governance, and obviously take it all the way up to the top. And I have the support of, you know, the the senior officers that I report to.
Excellent. Question now around the how, the process behind it, and any details that you can share about how you've gone about trying to standardize the forecasting process. Obviously different groups might have different approaches, different views as to how they're going to spend, and whether or not you've put any sort of standardization in place around how to estimate and how to forecast.
Well, we gave them a couple of tools. We gave them a contingency estimating calculator. So we published that on our society page. So if you're ever having trouble estimating how much contingency you should have, we developed some sort of calculator to allow them to do that. A lot of it was really just sort of project management education. Again, I was saying earlier that sometimes the project manager felt it was their role, and maybe this is true in some of your organizations, to run the project, and that the finance wasn't really their accountability. So what we try to do is we try to shift, say, no, you are also accountable to deliver this project on budget. So, we're a utility, and a lot of work that we do is risk avoidant. And so we have to make sure that the people running these projects know that they're accountable to do a better cash flow. So honestly, sitting down one-on-one, my EPMO folks would sit down and work with project managers, give them techniques, we try to avoid flatlining, try to get them to think about when invoices are going to come in, when they should accrue, when they should not accrue. So it's really a lot of one-on-one, but also it's a lot of publishing. I mean, if you share this information and project managers realize that, hey, my forecast is now being looked at, and my senior officer is going to get an assessment of how well I'm doing at my forecasting, I better spend a little more time on this. So, you got to break an egg to make an omelet. You got to publish this data. You got to get a little bit of, people aware that, this data is being now looked at formally, and I better step up my game.
What a concept, accountability.
Well, I know you're joking, but I think that, the project managers truly felt accountable for the projects, but we're asking for a whole new set of, again, I think that's where the EPMO comes in. It's the financial accountability. We're running this like a CFO would, and we want you to be accountable financially.
Yeah, absolutely. I mean, I think that's something that a lot of organizations can learn from, regardless of how they go about doing it. There's one question that came in here, and a number of people had sort of similar sort of themes around it, which was around the goal and objective setting, and whether or not this reforecasting impacted the organization's ability to set or maybe revise goals and objectives, because potentially we're impacting return on investments as we changed the spend forecast, potentially releasing funds to be invested into new initiatives to achieve additional goals and objectives, whether or not there was any tie-in between the reforecasting process and revised goals.
Well, I'm not sure if they were talking about KPIs, like our internal goals, or like board-level goals, but I would say that we are haven't gotten to the point yet where there have been that dramatic of changes. I mean, I think that one of the other pieces of value that we have added recently is that the company is trying to solve a myriad of equations. So sometimes when you're looking at things financially, you might be thinking about your earnings per share. Another way to look at your spend patterns are your KPIs, and how are you performing against your KPIs. Another way to look at your spend is how are you preparing for rate cases and establishing our rate cases, because we're a utility. And a lot of these can be in conflict with one another. So I think the good news here is that portfolio by portfolio, I'm able to share information that inspires great questions that enables us to think about those types of the question that you just asked me. What impact should they have, if at all, on our goals and objectives? And now having a lot of this analysis under our belt, what should they do how can they influence our budget setting for the future years? So I think we're still in the infancy stages of learning how this metadata that if you will, that we are creating and now developing will be utilized.
Excellent. A few people have been asking about resources, Frank, and different ways that resourcing is impacted by some of these numbers, and in particular around if you have a cost underrun or if your sweep reveals money that can be given back, how that ties back to resource availability to reinvest that money elsewhere, whether or not cost underruns are a result of resource unavailability and therefore they haven't been able to spend the money on projects, or whether or not you've got a way of tying that whole resource management, resource planning piece back to what you're doing from a financial standpoint.
Yes, that's a great question, and there's definitely an obvious linkage or dependency associated with resource management. So the one thing I would say is that when we sanction moves, when we release or when we approve a request, whether it's new or existing, the first question that we ask at the governance committee meeting is, do we have the resources to literally do this work? Even if we have the finances, do we have the actual capabilities and resources in-house? If we don't, we will not sanction the request. And then what we're also learning that a lot of times when I showed you those forecasts, our forecasts are assuming, and we're still getting to the bottom of this, but our hypothesis right now is that our forecasts are assuming a perfect usage and utilization of our resources, and in practicality that doesn't happen. In some cases we found different sides of the same portfolio counting or expecting the same resources to do double work, and so it has clearly pointed us into the direction of doing a better job at identifying our resources, if not at the named level, then at least at the skill level, so that we're able to better prepare for this. So I think we're just embarking on that resource journey now.
Excellent. Had a question that came in about the EPMO itself. And I guess we don't know how your EPMO was perceived prior to you starting this process, but did you have any challenges around changing the perception of the EPMO and getting to the point where the rest of the organization accepted that you were helping to drive the business forward as opposed to sort of being a PM support type organization?
Yes, I would say that there was initially that cultural aspect, and I think it still continues. It's gotten less and less when we're able to demonstrate the value. I think it's really important, again, the value that we're demonstrating is at the portfolio level, not at the project level. So I think that's been a huge differentiator. We're talking about millions of dollars and leveraging and moving millions of dollars effectively. So that's gotten the attention. I think the fact that does everybody love it? No. Why? Because look, nobody was doing anything wrong, nobody's doing anything bad, nobody was doing anything deliberately, undermining. But, human nature, everybody left to their own devices are going to do what's best for them individually. What my process does is brings it up a notch and says, okay, that might be best for you individually, but it's not best for the company. And so what we're going to do is we're going to sweep it away from you and we're going to move it here. So individuals may not like it, but I think at the senior level they see the value of this transparency and this accountability. But I'm not here to say that it was an easy sell. I think it's a slow and steady cultural change. I think the fact that I was also relatively new, I mean, I'm in the company for eight and a half years now, but still, utilities have a lot of longevity, and so I think me being new, relatively new person on the team, and providing all of this visibility and sharing all of these stats, it creates some organizational cultural angst. But I've been pretty steadfast, and I think the results speak for themselves, and therefore my senior leadership team has backed me.
Excellent. I'm going to try and squeeze in one more question. Got a couple of minutes left. I had a question about how you are going about measuring PM performance, and the questioner was a little concerned that, you know, if there's money being given back but the goals of the project are still being met, does that reflect poorly on the PM, or I guess poorly on whoever it was that came up with the original plan, which may or may not be the PM, but wondering whether or not the financial element is tying back to actual performance on the job.
We have not done that yet. I mean, right now, we're not looking to place blame or hurt any individual project manager. We're really just trying to strategically utilize our money. So I think over time, we're going to have enough data to see that there may be patterns of behavior that can be trained or modified or adjusted. But, you know, we're certainly not looking at this to be a punitive effort. We're really trying to collectively, we want to be a friendly, approachable PMO. We want people to want to use us. We don't want them to be afraid. We're not afraid to say what we have to say. We're not afraid to publish graphics and charts and give bad news. But we're not here to do it, you know, to hurt somebody. We're here to do it in the context of everybody wins by improving.
Excellent. And, well, I think you mastered the friendly and approachable piece, and judging by the response during the Q&A and during the presentation, you definitely hit a nerve with people. We could carry on for another 30 minutes easily with the number of questions we've got left. So I apologize to everybody whose question we didn't get a chance to get to. We will capture all the questions and we'll pass them along so that Frank can maybe speak to them in the next presentation. I did promise everybody that I would provide you with information on the PDUs. So this session is eligible for one Category C PDU, which is the self-declared section for self-learning. So if you go to PMI's website and go to the continuing education section, select Category C, enter in the details for this, you will be able to claim everything. That will be included in the email that you are sent within 24 hours at the close of this session, along with information on how to access the slides themselves and the recording. So the only thing really left for me to do is, Frank, to say a huge thank you so much for giving up your time today. It was an awesome presentation. I've heard you do this a couple of times before, and I learned something new every time. It's a great presentation, and what you've achieved at Keyspan and at Con Edison is tremendous achievement that's really sort of moving your organization forward. So congratulations on that, and thank you to everybody for joining us for another great webinar, and join us again for the next projects at Work.